This week or today, we're going to be looking at foreign subsidiary. All right. So I want to believe that when it comes to complex structure, when it comes to acquisition in piecemeal or disposals of subsidiaries, these are the major highlights that we have looked at. I want to believe that we do not have a problem, that it is clear. Sorry, if it is not clear, it is an opportunity for you to please let me know whether it is clear or not. If it is not clear, so that we can know whether we need to make an arrangement for another class or go back to those things. They will definitely even have to go back with questions though. Okay. I'll believe your silence means everybody is okay, we're all fine. So we're going with foreign subsidiary. All right. Foreign subsidiary means we're going to branch into a bit of something we likely must have done in FR. One very important standard there is IAS 21, which talks about the effect of changes in foreign exchange rates. But before we even get there, what is a foreign subsidiary? A foreign subsidiary simply means you have one of these situations where it will apply when you have a subsidiary or you have an associate that you want to bring into the books, or you have a branch in another country that is different from the country of the parent company.
Let me hear what?
Where the functional currency of that company, of that subsidiary or associate or branch is different from yours. So whenever this happens, you will need to make a translation of those, you need to restate the balances, as it were, in the separate financial statement of such foreign operations. You need to bring it to the presentation currency of the parent. So we're going to delve into it. We'll just look into some of the things that has been mentioned here already. All right, let's just look at it together. Okay, they said here an investor can buy majority shareholding in another entity that is located in another country, therefore having a foreign subsidiary. All right, they gave an example, and then we're told the way IFRS 10 applies is that it requires an entity that has controlling interest over another entity to prepare consolidated financial statement. The immediate challenge that jumps at you will be how you're going to translate, or restate the figures that you have in the financial statement of your subsidiary to the presentation currency of the parent. All right. Okay. First of all, let's look at the scope of IAS 21 with regards to this. IAS 21 applies to foreign activities in two instances. Number one is the instance of transactions that take place in foreign currency. Number two is foreign operations. Now, when we say transactions in foreign currency, what it simply means is not too much. It's just a company in Nigeria and we have transaction with another company in, let's say, United States of America, and they have invoiced us. They gave us an invoice in USD. This qualifies for transaction in foreign currency. Or we had dealings with a company in United Kingdom rather, and then we had to send an invoice to them in okay, no, that would not, okay, sorry. Okay, let's say we invoice another company in UK. We were smart enough to invoice them in GBP. However, the transaction has taken place. Our expectation is that we are going to receive our money in Great British pounds. Or let's say, for instance, we made an investment in Eurobonds. We made an investment in Eurobonds. And we are going to receive interest. We invested in USD, and so we therefore expect that we're going to receive interest or coupons, and then the amount we have invested back at maturity in USD. However, this is a company in Nigeria, meaning that the currency of Nigeria is Naira, and that company also reports in Naira. So this is a transaction in foreign currency. The fact that we transact normally in Naira, most of our activities are in Naira, and we also report in Naira. If we have invoices either for receivable or for payables in another currency, that is under the scope of what we call transaction in foreign currency. And what do we do? To recognize that transaction, we simply recognize the transaction at the spot rate, the day of the transaction. So if I enter into a transaction with another company, a Nigerian company enters into a transaction with another company in the United States today, and they were invoiced today, let's say 1,000 pounds, $1,000 rather, and the exchange rate as of today is, let's say, 1,500 to $1. This transaction will be recognized today in our books at 1,000 multiplied by 1.5 million naira. Therefore, I am going to recognize a payable at 1.5 million naira today. My simple double entry will be to debit my purchases. I'll debit purchase, and then I'll credit payables, 1.5 million naira. Why? Because I am going to report my financial statement in Naira. Okay? Now, if as at the day I'm going to make the payment, I am going to make the payment, let's say that took place today, and then tomorrow I am to make payment, and then tomorrow now came, and then exchange rate is now 1,450 per dollar. What it means is that I am still going to pay this $1,000, but this $1,000 that was 1.5 million will now be 1,450,000. How did I do that? By simply saying 1,000 times 1,450. And that will give me 1,450,000. Now, what I will do as of this day is to credit bank. First of all, if I don't know anything, I know I'm going to credit bank 1,450,000. Then I'm going to debit my payables, the same 1,450,000. Sorry. I'm going to debit my payable 1,450,000. But don't forget that just yesterday we had recorded our payable to be 1.5 million. All right, to be 1.5 million. So what does that mean? It means that what I recorded as payable is 500,000 naira. I mean, 50,000 naira more than what I eventually paid. Then I can say I have realized an exchange gain. Then what it means is that I'm just going to go to exchange gain. I'll credit 50,000 and then I'll debit payables with the remaining 50,000. This is as straightforward as it gets when it comes to transactions in foreign currency. So it's just about, then somebody may ask, what if as at the end of the reporting period, I am still owing this payable? Very simple. What is the closing rate as at the end of the period? If it is 1,450, I will still say my payable is no longer 1.5 million. It is now 1.4,000 naira. Will not be earned exchange gain. It will go to unrealized exchange gain. It will still go to my POL credit, unrealized exchange gain. If in the future, when I eventually pay, the exchange gain is not as much as that 50,000, all I will do is to reverse the portion that I have not earned and then take the remaining portion to my end exchange gain. So I believe this is as direct as it can possibly get. But do we understand this bit that I have explained? Why are you also feel in class? Mercy, is this clear?
Yes, yes, yes.
All right. Priscilla, is this clear? Chidima, is this clear? Willie, is this clear?
Yes, it is.
All right. Let me drop a chat to the WhatsApp. So few, I'm worried. Okay, now back to it. The second instance where we apply IAS 21, which will probably not have been touched too deeply as at the point when you were writing FR, is foreign operations. Okay. Now, for foreign operations, you have a case where there is a subsidiary, like I mentioned before, a subsidiary, an associate, a joint venture, or a branch of a reporting entity. And these activities that they do are based or conducted in a country or currency other than those of this. Let's say a Nigerian company or an associate or a JV or a branch in South Africa. South Africa spends rands, all right? Nigeria will spend naira. Now, it is the company in Nigeria that is the parent, meaning that when they are going to prepare and publish their consolidated financial naira, Oh, sorry. The network threw me off. I hope you can hear me.
Yes, sir.
Okay, now, so like I was saying, the company in Nigeria happens to be the parent company is the one that will present the consolidated statement and financial statement responsibility to restate income and expenses of their foreign operations in their own naira and then present to the public. Now, where this is the case, wherever this is the case, you will see when you deal with IS 21, there is usually the case of presentation currency and then what is called functional currency. Okay, your presentation currency is just the currency in which you are presenting the financial statement. It's as straightforward as that. But when we say functional currency, it can be simple and it can be a bit complex. What makes it simple is this. I am a Nigerian company. I operate in Nigeria. Then it means I should report in Naira, Abi. That makes it, because what is my functional currency is the currency of the environment in which I am operating. However, it may be a bit technical if the company is in Nigeria. However, most of their dealings, most of their business deals and activity is with a parent company in South Africa, meaning most of the transaction they are still doing is in South African rand. That's number one. It means that most of their invoices, their price is set in rand. Their inflows will mostly be in South African rand, even though the company is operating in Nigeria. In such a situation, then the functional currency will not be Naira, even though the company is located in Nigeria. Because it is very clear from the style of operation, they are not necessarily dealing, their being in Nigeria may just be so that they may be able to evade maybe some very strict regulations if they were to do the same business located in South Africa. It is from that indication, you can see that, most of their earnings, most of their invoices, and all of their dealings will be in rand. So therefore, their functional currency in such a case is rand. Now, the standard went further to break it down, how you see of an entity. I'll just skip all of this and quickly go there. We're going to come back to the rest of the things that were mentioned here. I just want to quickly highlight those ones. Let's see. Okay, you can see here it said IS 21 defined functional currency as the currency of primary economic environment in which the entity operates. Now, the primary economic environment in which an entity operates is usually the one in which it generates and expends cash. Now, pay attention to this. They said an entity determines the following in determining its functional currency. Number one, we look at the sale price. And in what currency are you invoicing? We have the case of many companies until I think regulation has restricted a lot of things on you have a lot of, we used to have a lot of, and we still do, they find a way to do it underground. Real estate that houses corporate tenants, I mean offices. Some of them back in the days were invoiced in dollars, especially on Lagos Island, Victoria Island, and Lekki, all those places, all those high-rise areas. You find out that because those operations are done in such a way that the rent they receive is going to be in dollars. So if they are owned by foreign real estate companies, in one way or the other, it's likely that their functional reporting currency is going to be dollars. They hardly deal anything in naira. All right. Okay. Another thing is you look at the currency of the country whose competitive forces and regulation mainly determine the sales price. Yeah, prices may be regulated. Now, that is what changed a lot of those companies to start invoicing and renting out in naira. So if you are operating in a country that has strict regulations against this, that means that you have no choice. Your sale price will most likely be in naira, in a currency, that location where you're operating. Another thing that may also influence is the salaries you're paying, the materials you are using, which currency are they invoiced to you, and which currency do you use in settling them. So all of these things. So it's really about, if it's not the primary economic currency of the primary economic environment, then we now tend to look at these factors. But mind you, you are going to be looking at these factors majorly when you have a situation where the company is usually a foreign operation to another parent. That's what usually would happen, that you now have this kind of scenario. But if it's a locally owned company that is not a member of, it's most likely going to be that their functional currency will be the currency of the home country where they are operating. All right. So all of that English is just so further evidences that may also tell you the functional currencies. Which currency do they get their financing activity? The equity and the debt capital. Look at it, in which currency do they normally issue equity or issue out debt instruments? Which currency dominates that composition? Another thing could be they are received from operating activities. In which currency is usually retained? Meaning, even if they were invoicing in naira, in which currency are they retaining those sales income? So it can be a bit complex when it's a foreign operation, but ordinarily, other than that, your functional currency and your presentation currency is most likely to be one and the same when it is not a foreign operation. All right. Now, all of this is just to build up into what we want to do. So we have looked at the first scope of IAS 21 when there is a transaction in a foreign currency, just a transaction. We might just have a few transactions that we did. We probably have Euro bonds as one of our investments. We probably have technology, our technology cost, IT, most of the time is charged in USD. So we probably have one or two exposures to dollar fluctuations, but those are just transactions. It does not necessarily mean we have a foreign operation. So that one is easy. I'm just going to restate the amount of the transaction at the spot rate. That is the rate of that particular day, the closing rate for that particular day. And then I'll continue to restate on the reporting dates. I'll continue to restate to the current to the current foreign exchange rates. So it means that if the transaction are taking place today, by the reporting year end, if that transaction remains unpaid, and that's what's going to take us into what is called monetary items and non-monetary items. We're still going to get there, but let's take it bit by bit. I just wanted to clear the issue of presentation currency and functional currency. So let's go back up. So now let's talk about foreign operations. When it is a foreign operation, then how do we apply IAS 21? Because what we are doing is really a combination of IAS 10 and IAS 21. How do we apply IAS 21 to translate the financial statement? What is the difference between transaction in foreign currency and this one? The difference is this. Transaction in foreign currency, I am just converting from dollar to naira because I did a transaction in dollar. But when it comes to foreign operations, the reason I'm doing it is because I need to restate all of the numbers that make up the financial statement into the presentation currency of the parent. So that's the major difference between the both of them. But we are going to see more differences in terms of what is the rule that you will apply to translating assets and liabilities, what is the rule you will apply to translating equity, what is the rule you are going to apply to translating income and expenses. So we're going to look at that now. All right. So I want to skip a few things here. And come to this place here where we'll talk about monetary items. So what really are monetary items? Monetary items are, let me see how it is defined. I said items whose value is not affected by changes in exchange rates. And they give an example, cash, trade payables, and loan items. Any important foreign supplier, and I have been invoiced $1,000. This is a payable. Or I invoiced somebody in a foreign currency. I have a receivable of 1,500. Or I kept foreign currency in the bank. I have foreign currency in the bank, my bank statement. I have a domiciliary account where I have about $10,000. These values are not changing. This is what they are, but they are just stated in a foreign currency amount. However, at a particular point in time, I am going to crystallize these balances back to naira. What do I mean? The payable I will eventually pay. The only thing is that I know the value I'm going to pay in dollars. But what I will eventually pay will be stated in my books in naira. That is the only thing. In terms of receivable again, I am going to receive this money. I may not know how much I'm going to receive in naira, but I know I'm definitely going to get $1,500 sometime in the future. Or my $10,000 that is sitting in the bank, I know that I have $10,000. If I take this $10,000 or any part of this $10,000 The only thing is that it will be translated to Naira as at the day I'm getting it. So monetary item, while I look at monetary item is that I see it as something that I expect to crystallize back to my Naira value in the future. In the future. So if I look at it that way, I can never get it wrong. What I ask myself is it something I'll still have to pay, or is it money I'll still have to receive? If it's an investment, I'm definitely going to get interest in the future. So I'm expecting to receive money. If it's a loan, then I have to make repayments and interest payments. So I'm expecting that money will still flow out or money will flow in. That's how I look at it. But when it comes to non-monetary items, it is a transaction I am done with, and it is done with. It's not that I'm going to have to still make any payments in the future. What do I mean? For instance, we bought PPE, we bought a car. We bought that car for $50,000. I'm not making any further payment after I made this $50,000 payment. So in this case, this one will be a non-monetary item. I am not expecting that I'm still going to have to make any payment on the PPE or whatsoever. If I translate this PPE to Naira, I can go ahead and continue to do my depreciation in Naira. It's as good as that. Now, what do we do when it is a monetary item? When it is a monetary item, you are expected to translate at the closing rate. When it is a non-monetary item, you are permitted to translate at the historical rate. So if I bought an item of inventory, I can take the balance of that inventory in, and it will remain at the rate I bought it then. If I bought machine and equipment, I can translate it to Naira and leave it at that Naira rate like that until the day I ever revalue, and my revaluation will be in Naira. However, if I owe another person, common sense is that if I owe another supplier $1,500, the impact of the foreign exchange rate will make me either pay more than I am recording today or pay less than I have recorded today in the future dates that I'm making that payment. So that is how I look at monetary and non-monetary items, so that I don't confuse myself with, the standard gave its own definition. However, in practice or even in the exam, how you quickly spot what is a monetary policy and know how you are going to go about dealing with such transaction if it's a foreign currency, especially even when you're dealing with, okay, it doesn't really come into the scope of SFM like that. But then that is the guidance that I use. So is this clear? This monetary and non-monetary aspect, is it clear?
Yes, sir.
Okay, all right. Let's move on. So I'm just going to skip all of these stories as well. So exchange difference will arise when there is, I think I've also mentioned this, the transaction date and the date of settlement. Whenever it is monetary items, you're going to have exchange difference. Whenever it is non-monetary item, remember you are keeping it at the historical rate. The rate at which they came into your books is going to be how you're going to leave them. Okay. Let's look at a question on exchange difference. We're told Waki Limited, a local company whose year end ends on 31st December, buys goods from Sauti Limited of South Africa, of course, on 30th September 2017. Now the invoice value is 90,000 rands and is due for settlement in equal installments on 30th November and 31st January. Okay, the exchange rate moved as follows. Okay, 30th September, 30th November, 30th December, and 31st January. We're giving the exchange rate for those dates and asking us to state, the accounting entries in the book of Waki Limited. So let's quickly look at this. The date of transaction is actually this date, 30th September 2017. And the exchange rate as of this day is 2.6. So it means that in the book of Waki, what they are going to have is, they're going to have, they're going to have in Naira, it will be, in Naira, it will be 90,000 rands. As of this day, it will be 90,000 rands multiplied by 2.60. 90,000 multiplied by 2.6 gives us 234,000 naira. Now, when are they supposed to make payments? They said they are supposed to make the first installment 30th November. As of 30th November, it will be 90,000 times 2.8. Okay, they said 2 equal installments. So that means they are paying 45,000 times 2.8. What is 45,000 times 2.8? Somebody help us with that. 45,000 times 2.8.
126,000.
126,000. All right. Thank you. 126,000. Now, as of the date of the transaction, they would have recorded debits, purchases, or we can even say debit inventory or purchases at, that will be 234,000. And then we're going to credit payables. Payables at 234,000 as well. Now, on 30th November, they paid this amount. What you must also not forget is that, sorry, I'm making a mistake here. So this is the thing. If I didn't even pay attention to this, if it takes 2.6 rand to equals 1 naira, do you agree with me that then naira is the stronger currency? I need us to unmute. That naira is the stronger currency, all right?
Yes, sir.
So when you are converting to the stronger currency, what you do is you divide, not multiply. Let me first of all retrace that. When you are converting to the stronger currency, like for instance, if I am converting from Naira, let's say current rate is 1,500 to $1. So I now have 90,000 Naira. They say I should convert 90,000 Naira to dollar. I won't be multiplying by 1.5. What I'll be doing is I'll be saying in dollars, it will be 90,000 divided by 1.5. Is this clear? And that should be about, is this $6? So that is the conversion, how you do conversion, sorry. So what I should have done here on 30th September, we should just have said 90,000 divided by 2.6. All right. So what is 90,000 divided by 2.6? Anybody, please? 90,000 divided by 6. I mean, divided by 2.6. I got 34,615.38. 34. $34,615.38. That's the amount in Naira. So what should be here is that amount. 34,615.38. 34,615.38. Now, as of the day they paid 45,000, what they would have paid in November, exchange rate is now 2.8, would have been 45,000 divided by 2.8. And that will give me 16,071 Naira, 43 kobo. 16,000 71 Naira, 43 kobo. All right. Now, if I want to record that, I'll just come and say, ordinarily, if the rate had remained at 2.6, these 45,000 rands I am paying would have been how much? It would have been 45,000 divided by 2.6. All right. And that would have been, I would have had to pay more in Naira. That would be 17,307.69. Good. 17,307.69. Now, what this means is that there is an exchange difference. What is the exchange difference? The exchange difference is the difference between this amount that I would have paid if the exchange rate had remained at 2.6 and what I am eventually paying now. All right. And what is the difference between the two figures? The difference there, this minus is 3. I have 1,236.26. 1,000 Naira. 236.6. Is it 62 or 63? I mean 26 rather. So how do I go about this? The double entry is quite easy. Simply just say we are going to debit payables, credit bank, start with crediting bank. Bank will be credited 1607.43. The payables should be debited all of what we should have debited it, 17,307.69. The difference is going in as exchange gain because we are paying less than we ought to have paid, and that will be 1,236.26. So it's as simple as that. That will be done on 30th September. Then 31st December, because it is our reporting date, I cannot carry the amount remaining is this, it's into half. So we have another 13,307.69 naira in our books as payables. All right. So what I will do as at 31st December, when it is now 2.9, all right, I can do one of two things. I can either say this naira value, I'll multiply it by 2.60 and then divide by 2.90, or I can say what I have left is 45,000 rands, and then I can do 45,000 rands multiplied by 2.9. That is what will go into my receivables, to my payables as of that day. If I do 45,000 multiplied by 2.9, I get 130,500. Why am I multiplying? Sorry. 45,000 divided by, Holy God, will help me with this multiplying. Divided by 2.9, I get 15,517.24. Now that 15,517.24 is different from the amount I would have left, which is 17,000 plus. All right. So what I would do is to now reduce my payable. I'll reduce my payable by the difference. The difference between them is coming minus 17,307 points. Why is my calculator not working? What do we get? About 1,800 or thereabouts. We now go to my unrealized exchange gain. The difference between this exchange difference and the one we did earlier is that the one we did earlier, that one, you have already made that payment. So that gain you made is a realized gain. So it's an end exchange gain. But in this case, you're only recording a gain because you have to translate at the closing date. So this will go to your unrealized exchange gain. There's not so much headache around it with regards to the exam in terms of what you are doing. I just have to make that distinction, especially for those of us who are working practically or professionally in financial reporting. I just want to ask, do we have a problem with this? Because I want to move on away from here and face what is the major thing. I think the solution is here. Let's just look at the solution. I think my My calculation is beginning to go rough. Okay, all of that is explained here. As at 31st December 2005, you see they came down to that same value. And then realized this as an exchange gain. So this one is done. You're debiting trade receivables to reduce what is it called now? To reduce the payables as of that day, because you have made an exchange gain. All right. Now, when the payment is eventually made, January 1st, 2018, that balance payment, you do it with the exchange rate of that day as well. I think it was 2.85. And then an exchange loss was made because between 2.9 and 2.85, it definitely means that the currency rand had gained over naira. So that's it basically. Do we have any questions around this? This is just to walk you through the conversion process, so to say. Do we have any problem around this one? Mr. Esang, is it clear? Olumide Olorin, is it clear?
Yes.
Chidima, is it clear? Thank you. Priscilla, is it clear?
Yes, it's clear, sir.
All right. So let's move on. Okay. Let me just summarize this way. This is what we're going to do. This is what we're going to do so that we can move on quickly. You see, there are a few steps when it comes to consolidation of a foreign subsidiary. They just used it directly in the solution. I'm just going to spell them out like this. The first thing to do is translate the SOF using the closed. However, be careful about I'm going to come back to talk about it. Number two is to translate. That's the step number two. Translate the SOPL of the subsidiary. Translate it using the average rate. Translate it using the average rate. Step number three is to calculate the exchange difference. Calculate the exchange difference. And step four, if the question requires you to do consolidated statement of changes in equity, then it means that you are going to need to calculate the retained earnings growth form. We are going to look at how you are going to do that one. So these are the 4 steps that you must be able to do combined with everything that we've already taught you in terms of consolidation. And this one is not that my own exam, that's May 2017. When I wrote CR, it was foreign subsidiary. And I remember I was very, very happy that it was foreign subsidiary because of how easy it is. I'd rather have to do that than do any other part of the consolidation. That's how simple it was. All right. So let's move into it. But I said be careful about equity here. Let me shed some light on that. Now, my assets and liabilities, I can do close rate for them, no problem. Not a big deal. But you see, when it comes to the ordinary share capital, I need to be careful. Why? The reason is that in the record of the parent company, they are still going to be recording the ordinary share capital at the historical amount that they bought it in the presentation currency. What do I mean? If PICO is a Nigerian company, ESCO is a South African country, and they bought the shares of ESCO, even if they paid in rands, in their separate financial statement, they would have converted it to Naira. Their investment in ESCO will be in Naira, and expectedly, it should be at the historical amount that they invested. If I now want to translate this ordinary share capital of the subsidiary, and I am translating it using the current rate, there's going to be a mismatch between what the parent company records as their investment in ESCO and what is the ordinary share capital of ESCO in Naira. So what do? We translate this at historical rates. That's number one. Now, this conversion thing that we are doing, or this translation thing that we are doing, we expect that it's going to bring about some exchange difference. Now, that exchange difference, you book it into your retained earnings, and you will take the income leg to your OCI. So therefore, even my retained earnings, don't let me speak plenty English, is going to be a balancing figure. You are going to see that when we attend the question that we want to do now. All right? You're going to see that. So let me ask, do we understand the steps? The steps are very straightforward. I am translating the SOFP of the subsidiary into the presentation currency using the closing rates. I am also going to translate their P&L figures into the presentation currency using the average rates. Then step 3, I made mention of an exchange difference. We expect that there's going to be an exchange difference. Now that exchange difference, I said you take it to your retained earnings, and the income leg that it will not go to P&L, go to your OCI. And then I said, if the question is asking you to do consolidated statement of changes in equity, then you are going to get okay. Now, let's get into it.
So I have a question.
Go ahead.
So you had mentioned earlier about the monetary value and non-monetary value and how we should use closing rate for non-monetary values. So does that not apply here as well?
No, it doesn't apply here because what you are simply doing here is you are just translating those assets and liabilities of a foreign operation so that you can harmonize or consolidate. I don't know if you understand what I'm saying. You see, that rule will apply to the subsidiary in their separate financial.
I can't hear you, sir.
If you are looking at S in their financial statement, if they are engaged in a transaction in foreign currency, or even if it is people that did a foreign. Hello, can you hear me now? Hello?
It keeps breaking.
How about now? Is it better now?
It's better now.
Can you hear the class? Hello?
I can hear you now, sir.
Hello, can you hear me now?
Yes, it's way better.
Is it much better now?
Yes, it is.
All right, thank you. All right, so what I was saying was this. How it applies when I am dealing with the separate book is slightly different from when you're looking at it from consolidation. For consolidation, all I'm doing is, these are the numbers for the subsidiary. I'm just translating them to my own the functional currency of the parent, or you can say the presentation currency, because we want to present the numbers in that other currency. But you see, in the separate book of either the parent or the subsidiary, that non-monetary and monetary item I was explaining the other time, that is exactly how it's going to play out. For monetary items, you're always going to be restating them at your reporting date into the functional currency of whoever is reporting. And whenever they are non-monetary items, you don't expect to receive money, you don't expect to make any payment. You have already made that payment, or you have already received what you ought to receive, and there's nothing else again. So in those instances, your non-monetary items will be stated at the historical value. And now that explains, I have worked in a place before where I discovered that the system would, by itself, whenever any transaction is entered in foreign currency, it would continue to revalue, which is fine. It means that it's away from, because it can be complex. It can be complex when you have so many transactions in foreign currency. It can be complex. So what it means is that it is devoid of human interruption or error or whatsoever, which is fine, good. But where I had a problem was I began to see PPE. PPE was being revalued. I say, why is PPE being revalued? PPE should not be revalued. Don't revalue because you're just going to mess it all up. I am not expecting to pay any amount further. I don't owe anybody. So why am I going to be getting exchange gains or losses on an item that I should have kept at the historical cost? I don't know if you understand what I'm saying. If my receivables is changed, okay, go ahead. Do you understand what I'm saying?
Yes, I understand.
So if it is an item that I expect to pay an amount in the future, or I expect to receive an amount in the future, or is my bank balance that the system is revaluing, I don't have a problem with that, because yes, I know that one day a transaction will crystallize that unrealized exchange gains that the system is calculating. And once that is crystallized, I will know whether to unwind all the unrealized gains that it had previously recorded, or will now have more, and then it will become end. So, but when it comes to consolidation, we need to go back to those rules that I have given. All your SOFP, translate them using the closing rate, except for equity. When you get to equity, realize that not just even, I made mention of ordinary share capital, not just even the ordinary share capital alone, even the pre-acquisition retained earnings of the subsidiary. You have used that you must have used what you translated to in the past. I mean that pre-acquisition retained earnings. You must have used it to establish the goodwill in your presentation currency. So if you keep changing it, are you going to keep going back to the calculation of your goodwill? You won't do that. So what you should do is just keep it at the historical rates, both the ordinary share capital and the pre-acquisition retained earnings. And then we know that the earnings, the further earning going forward, will be a balancing figure, because there's going to be an exchange difference that will either be a gain or a loss, and that will also impact your retained earnings. But when we get there, you will understand it better. But what I just want you to know for now, straight to the point, is the subsidiaries SOFP will translate at close rates or closing rates. The SOPL, we're going to do that at average rates. Just keep these two in your mind, and know that we are going to do a working for exchange, and it's not a big deal. It's not a big working like that for exchange difference. And like I said, you may need to do a reworking, how do I call it now? A walk back if the question is requiring you to do consolidated statement of changes in equity. And what is the meaning of that? That work back is you need to get the opening retained earnings, opening net assets, because of course, when you are doing statement of changes in equity, what you are using it to show is the movement between the opening balance in terms of equity and the closing balances in terms of equity. So it's as straightforward as that. Just keep these steps in mind, so that when I'm doing it, you will understand why we are doing what we're doing. All right. Okay, let's get into it. Let's use this question. Let's use this question. All right. Okay, all I've just mentioned there is what you find around this place. Asset and liabilities are translated at closing rates. The balancing figure in the foreign operation statement of financial position represents the parent's net investment in the foreign operation, which is the share capital and reserves of the foreign operation. Alternatively, the share capital and the pre-acquisition reserves can be translated at historical rates, while the post-acquisition reserves will be the balancing figure. We'll see what I mean by balancing figure. We'll get there when you see it. And then said all incomes and expenses should be translated using the average rate. And then exchange differences should be recognized in the OCI. All right, let's get to it. Question 1. We're told the abridged statement of financial position and statement of profit or loss and other comprehensive income of Fred Co. and its foreign subsidiary, Monarch Co. are as below. Statement of financial position as of 31st December 2017. Then we're given the non-current asset values, the current assets, equities, and liabilities. We're told we have the statement of profit or loss and OCI for the year ended 31st December 2017, given down here. And they were given additional information. We're told the exchange rates for these various dates, the date of incorporation of Monaco, the day of acquisition of non-current assets, 31st December 2016 close rate, 31st December 2017 average rates, and 31st December 2017 close rate. We're told to prepare consolidated statement of financial statements of Fredco. If the different dates that they have given you confuses you, shall know that the date of consolidation is very important. What is the date of consolidation? According to the question, it is 31st December 2017. So when I'm translating my SOFP figures, I am translating them using the close rate of this date. When I am translating my SOPL rate figures, statement of profit or loss and OCI, I'll be using the average rate for this year, which is what we have here. And this is the close rate. All right. Where's my phone? I would like to do something. I think my solution will be too rough. It will be too rough if I have to do it here. Can I do a whiteboard? You guys can follow with your, if you have other device, it will make it easier to follow. Can I go ahead and use a whiteboard?
Yes.
Okay. So that means you have access to the question. You don't have a problem with access to the question.
No, you don't have access to the question.
How do I now use whiteboard? What did you say?
Can you please send it to the group chat, like the question? So follow from there.
Okay, do like a screenshot and send it to
Yeah.
the group chat. Okay. All right. I think that makes sense. I think that makes sense. All right. Give me a moment. All of the question is not even on one page, but no problem. Or do I even have the, let me see if I have the Word version. Okay, I don't have it. Translate subsidiaries SFP at close rate. All right. The close rates our figures in rand, and then the close rate as of 31st December 2017, according to the question, was how much? Let me grab my phone. How much, please? What was the close rate?
2 rands to 1 naira.
So it was 2 rands to 1 naira. So now what it means is that naira is a stronger value than rand. All right. So if naira is a stronger value than rand, when I'm converting to naira from rand, what I would do is I would divide by these two. Okay. Non-current assets. We have plants, Abby, and that plant was 600. So when I'm converting it to be 600 divided by 2, and this will give me 300. All right. And then I have current assets, inventories. Inventories 400. 400 divided by 2, that gives me 200. I have receivables. My receivables 200. 200 divided by 2, that should give me 100. All right. In rand, this translates to 1,200. However, in naira, this should translate to 600. Now, in terms of my equities, ordinary share capital was 200. I said be careful here that because the share capital, which will be investment in, what's the name of the company we are dealing with? The subsidiary is Monaco and the parent is Fretco. Abi? So in the books of Fretco, in their separate financials, I'm sure they will have investment in Monaco. And they would have added, why am I even saying it as if? Let's look at the question. Let's look at the question. So even I have to look at those images. Let's look at the question. Investment in 200 shares. That's that of Monaco. Investment in shares of Monaco. You have 50. All right. So what we are saying here is that those 50, that's 50 naira that you have there must have been the translation figure or the converted naira amount for what they invested in the ordinary share capital of Monaco. So they will continue to carry this 50 naira historical amount. So therefore, when you are converting, do yourself the favor of not converting that ordinary share capital at the closing rate. Instead, do it at historical rates. All right. So I'll come here. What is the historical rate? On what day did they purchase those 200? It must have been from incorporation, from inception. All right. Because they didn't give us the date. And we have been told that they own fully Monaco. So what is the date of incorporation of Monaco? Which day were they incorporated? That date is the historical rate that we are going to use. Is this clear? Is this clear? Oh,
So.
What did you say? Mercy. Is Mercy still in the class? Ogenetega, is this clear? Cyril Olusoji, is this clear? Priscilla, what did you say?
It's to get clearer as we go on. It's not completely clear yet.
Okay. All right.
Sir, you said on which date? Is it incorporation?
Yes. So I'm asking if it is clear why I want to use incorporation date.
Okay. Yes.
All right. Okay. So the reason, let me just come again. The reason why I said incorporation date is this. The question would be, if I am to use historical rates for share capital, it means the rate I am using is the date when Fredco invested in Monaco. All right. Now, the question did not tell us, the question told us, I'm the one who is mixing it up. The question did not tell us the exact date. All right. If you look at it, the question didn't tell us. So it means that Fredco bought Monaco. I can make that assumption that they bought Monaco right from the inception of Monaco. So if that be the case, and I want to do historical rate, the historical rate I will fall back to will be the date of incorporation of Monaco. All right. Okay, so let me move on with that. So that rate is 4. All right. So I'll come here and say 200 divided by 4. And that gives me 50. Now, if you go back to the books of Fredco, investment in 200 shares of Monaco, you will see that it is 50 naira that is there. So what I was trying to say is that you don't want a situation where there is a mismatch between how your non-controlling interest and parents, how the parent has recorded the investment in subsidiary. So that's why you go back to the historical rate. You're also going to do historical rate if there is a pre-acquisition retained earnings. Because like I made mention, for the group account, you would have calculated goodwill on consolidation right from the date of acquisition. So therefore, you don't want to create a situation whereby you are translating and then there's a mismatch between the pre-acquisition retained earnings that you used in your calculation of goodwill and going forward there's another amount. Let's move on. In this question, if we are assuming that Fredco bought Monaco from inception, then it means that there will be no pre-acquisition retained earnings. Then the whole of the retained earnings here will be a balancing figure. Now, how much is the retained earnings in rand? It is 560, meaning the net asset here is 760. Now, this 560, I am going to do balancing figure here. I don't know how much I will get. However, let's go on to loans. Under liabilities, non-current liabilities, 220. 220. I'm going to go back to the closing rate. 220 divided by 2. That gives me 110. And then lastly, I have current liabilities there, which is also 220. 220 divided by 2 will give me 110 there as well. So my liability is 220 in Naira. However, my total assets is 600. So if my total asset is 600 and my liability is 220, all right? If my liability is 220, then the balancing figure here, or I can do it like this, if liability is 220 and the total is of equities and liabilities is 600, then my equity should equal 380. Now, if my equity is 380 and I have 50 as my ordinary share capital, the balancing figure here should be 330. All right? So that's what I mean by the balancing figure here. The danger really is if you have gotten your total asset wrong. That your balancing figure will not be correct. So imagine I had done something wrong here and I had gotten 800 here. So my balancing figure would here, I would have said it was 530, and that would have been wrong. And the reason it would be wrong is because I did not calculate my total assets very well. All right, let's move on. Step 2. I said step 2. Translate the subsidiary SOPL at the average rate. Thank God their SOPL is not so long. Okay, I'm just going to say what is the average rate? I have figures in rand. The average rate for 2017 is how much? What did you say?
3.2 rand to 1 naira.
Okay, 3.2 rand to 1 naira. And they have naira. Okay. So my profit before tax was 320. So I'll say 320 divided by 3.2. That should translate to 100 naira. And then tax, 160 rand. 160 rand. Sorry. 100. Okay, this should translate to 50. 160 is half of 320. All right. And then my PAT, profit after tax, will be 160. So this will translate to 50. All right. Now, in terms of exchange difference, I want to know if by the time I compare what should have been my closing net asset, if I compare it with this closing asset I have here, closing net asset I have here is 380, Abi? Okay. Would I have had an exchange gain or an exchange loss? So pay attention to what I want to do here. Now start like this. In rand, the closing net assets of Monaco, you will agree with me, it is here, 760. When we added the ordinary share capital and the retained earnings of Monaco, we had 760. All right. Now, if you check their SOPL, this is their profit after tax or their profit for the year. Now, the profit for the year was 160, meaning if I take that away, I should have their opening net assets, which will give me 600. Now, if I convert their opening net assets using the rate as at December 31st, 2016, because I am going back to the balance they had at the beginning of 2017, which is the same balance that they closed to it in 2016. So if you check the rate as of that day, the rate, or you can call it the opening rate, which is the closing rate of the previous period, was 4 rand equals to 1 naira. Therefore, the opening net assets in naira would have been 600 divided by 4, and that should be 150 naira. All right. Now, if their opening net asset is 150 naira and our profit for the year in naira is 50, then it means that profit in naira is 50. Then their closing net assets in naira ought to have been 200 naira. But when you come to the translations we did here, the closing net asset of Monaco in naira is 380. This is an exchange gain of 180. If I take you back to our material, they said it means it's a net increase in the investment of Fredco in Monaco. This is the exchange gain I was referring to. So we have an exchange gain of 180. And how do we get that exchange gain? We simply walk back to what our net asset, the net asset of the subsidiary, should have been in naira versus what it is when we did our translation of the SOFP. That difference, if it is a negative, then it is a loss. If it is positive, then it is a gain. All right? Now, this question requires us to do the changes, consolidated statement of changes in equity, which means that, like I said, we are going to do the retained earnings brought forward. Okay, there's not enough space, but let's even try and do what we have here. Let's see what it will culminate into in terms of the solution. All right, in terms of the solution. So I want to stop sharing the whiteboard and go back now to the solution. All of this is just to see the breakdown of how it was done step by step. Go ahead, Mr. Echo.
Sir, back to the SOFP. Are you saying that if I use the correct exchange rate for the ordinary share capital, I will always have the same cost of, I will always have the same amount in the ordinary share capital with the investment in Monaco?
Yes, if the case is that the parent, like this case now, has invested, has 100% equity interest. Now, it won't be that simple if it is a case where they do not own 100%, which is likely going to be the case you are going to face. However, your guidance will be this. If they say they have 80%, all right? They have 80%. Whatever I have translated back to, if I calculate the 80%, it should be the investment that the parent company has made. So I can use that to tie it and know that, okay, good. However, again, it can still be a little bit more complex than that. Why? Because it is possible that Fresco did not purchase all that investment at once. It could have been a piecemeal acquisition. Do you understand? So it can be as complex as that, but I don't see that happening in your examination. I don't see them mixing piecemeal acquisition, then they now add foreign subsidiary into the Gary again. It will be too much. Kumbaya, a lot of stuff for you to wrap your head around in the examination. But the guidance I'm giving you is so that the reason why we are doing at the historical rate is so that you don't have that kind of a mismatch where investment in subsidy, because of course, like I even made mention, you would have done goodwill on consolidation at acquisition. So when you were doing your goodwill, you must have used that historical rate in that calculation. If you are now going to go forward and keep consolidating in subsequent years, I know of a situation where a real life scenario where this caused reconciliation issues. So apparently, the company had gone ahead to consolidate using the closing rates, but the auditor was able to point it out that, oh, this is where we are having the issue, right? So it's something that can happen in reality where you want to make that kind of error. All right. So your ordinary share capital, your pre-acquisition retained earnings, these two, you continue to what is it called? You continue to restate them using, when you are restating every other thing, you restate them using historical rates. All right. It's not more than that. Is it clear? Mr. Epo, is it clear? Did I lose him? Oh, probably. All right. My battery is running low. Let's quickly go back to the material itself. Where is it? All right. Okay. So what you see here is simply what we've done. The step one is the same values we have. I left something behind. Okay, let's come here. I want us to look at it together. So they said exchange differences will usually arise from translating income and expenses at average rates and asset and liabilities at closing rates. Also, exchange differences can arise from translating opening net assets at a closing rate that differs from the previous closing rate. Now, because assets and liabilities are translated at closing rate, so the rate we use in this current period will be different from the rate we use in another period, which will influence the net investment in the foreign operations. Okay, so know that exchange difference will occur, first of all, as a result of the fact that your SOPL, you did it at average rates, your SOFP, you did it at closing rates. And also because you have done these balances on your SOFP at the current year closing rates, don't also forget that in the previous year, those balances you had in the previous year, you did them at the closing rate of the previous year. So you are still going to have another exchange difference. So that's what we just did now. All right. Let's move on. The exchange difference that comes from between closing and average rates, we have localized that into the retained earnings. That's why we did balancing figure. And then the exchange difference we have as a result of close rate of the previous year that we applied on the balances of the previous year, and the balances we now have in the current year on our SOFP using the closing rate of that year. That difference is what we calculated last. All right. So this was what I left behind the other time. I still think we should come back to it later. Let's quickly, before my battery runs down, let's quickly look at the solution. If you look at the solution, what we've done here, SOFP, let me even come here so I can speak on one or two other things. Now, this translated to 300, this 600 translated to 300. Remember, we divided by 2. So if you add this, you get 1,000. Your plant is 1,000. Investment in equities. This one was cancelled out against the ordinary share capital of Monaco. What do I mean? We translated this ordinary share using the historical rates, and then we got 50, if you recall. So you had cancelled that against that investment. So what it means is that there is no goodwill to replace it, and you will not you're definitely not going to have investment in Monaco going to appear in the consolidated statement of financial position. Now, in terms of inventories, we must have divided this one 2 by 2. Then we got 200, 450 plus 200 inventories would have given us 550. And then receivables, we must have divided this one 2 by 2. Then when you add this, you have receivables of 400. So this gives me 1,950. All right. Ordinary share capital of the parent is 600. The retained earnings, I think this was 330 the other time. So if I do 600 plus 330, we get 930. All right. So this gives me 1,530. And then these all liabilities give us 220. 110 plus 110. So if I add that to the 300 I have here, or let me take it one by one. Long term loans, 110 plus 100. That should give me 210. All right. And then 110 plus 200, that should give me 310. Zero, 5. This will give me 0, 200. Did I make any error there? Okay. This is 100 plus 110. 100 plus 110, that should give me 210. 200 plus 110, that should give me 210 as well. Sorry, 310. Let me see the solution. Where is this error coming from? Okay, inventory should have been 650. How did I not get 550? Let me check. Oh, 450 plus 200. So that should have given me 650 instead. So this should have given me 650. So this is 2050. And then this is 2050 as well. So that is our statement, consolidated statement of financial position. Okay. Yeah, we have made one or maybe two simple assumptions with this question, but by and large, it's the same steps we would have done. Maybe one or two things would have come in, like calculation of goodwill, or would not have. I'm talking about practical exam question. We also not have assumed 100% ownership, perhaps, but the steps, the principle is the same. All right. Let's look at the consolidated statement of profit or loss. You would have the same figures. Okay. We had 100 the other time. We had 50. They just basically added that. Now, I said your exchange difference goes to your OCI. All right. So this is the 180 we had the other time. And of course, they had consolidated all these numbers. So your statement of SOPL and OCI consolidated. We've not done any magic. We've simply just added the numbers we had on the parent statement of profit or loss, and then we added the amounts we converted using average rate the other time. And that's it. The only thing that is new that is coming in is the exchange difference that we calculated the other time. Now let's quickly look at how we would have done the movement of the retained earnings. All right. So we don't have a problem with that of the subsidiary, that of Monaco, because we've done it already when we were trying to calculate the exchange difference the other time. However, that of the parent, Fretco, we simply just add what we have for Fretco and what we add for, what is it called now? For Monaco, okay? Retained earnings brought forward. Fretco, we had 400. Sorry, I want to go back. I want to go back and see something. How did we get the 400? All right. For Fretco, don't let me go far. Retained earnings as at 2017 stood at 600. Okay. And then the profit for the year was 200. So if you remove the profit for the year, what you have is 400. This must have been their opening retained earnings for Fredco. And that's why you have it like that in our calculation. All right. Now let's look at what was done for Monaco. For Monaco, you will recall that we had an opening net asset the other time. Let's check again. An opening net asset in Naira was 150. All right. This 150 that we have here. Now, this net asset includes the ordinary share capital. And the ordinary share capital, like we have formally established, is 50 Naira when we converted to Naira using the historical rate. So just take out that 50 Naira from there, you have 100 Naira. So now this is the opening retained earnings for parents. Add it to the opening retained earnings of the subsidiary, which is 100, you get 500. Now, in between them, their OCI was, what did we get as the OCI the other time? I mean, the total comprehensive income was 430. And that's how you get this 930. If you check very well, is that same 930 you have in your consolidated statement of financial position? Is that same 930 we have there? Okay, so this is what it's not a big deal like that. The statement of consolidated statement of changes in equity. It's just you working back to get your opening, add your total income. And then if where the issue is usually is when what is it called? This balance carry forward amount is not the same as what you have in your consolidated statement of financial position. If by and large what you have been doing is correct, just go back, check how you got your balance brought forward very well. And at times, the examiner would have given it to you. I think that was what they were speaking to here. They said, note, you can only determine the retained earning brought forward as the balancing figure if the consolidated statement of profit or loss and statement of financial position have been prepared. However, if they are not prepared, you can determine the retained earnings brought forward as presented in workings 4. So you could also have it given to you and then you just work with it. Okay. By and large, I think that's what we'll be able to do today. I'm looking at question 2. Might take me at least another 20 to 30 minutes. The battery level I have left is not as much. Just about 15 minutes. But my question will be this. Do we understand this question we have solved? Praise. Pascal, Olumide, Ogenetega. Well, I didn't hear you. I think the network was bad. Praise, what did you say?
I said yes, sir. Like it's clear.
All right. Priscilla, is it clear? Chidima, is it clear? Ogenetega. Priscilla, I wanted to say something.
I had to go back and recap on this because I wasn't really paying attention. Apologies.
All right. That is fine. Priscilla, you wanted to say something the other time.
I was just responding. It's clear, sir. Thank you.
You're welcome. All right. Okay, well, we'll meet next week. I am hoping we can start earlier by the special grace of God. I'll just have to find a way because we're close to rounding up on the group aspect. Wait, today is 23rd. Wow, 2nd of March. All right. I think what we have left after this is IFRS 11, joint arrangements. If we can clear that, I can say I'm done with group, even though we'll still do group cash flow. But that group cash flow, I will say I am taking off another topic of my, as IAS 7. Okay, all right. So next week, we're going to start earlier by the special grace of God. We're going to start earlier by the special grace of God. Let's say 7, or if possible, go on 6:30, so that I want us to round up on foreign subsidiary, and then joint arrangement, joint venture. That shouldn't take too much of our time. We're far behind. We are far behind. All right, but we can accelerate things as well. I want to ask our weekend classes. I think on weekend that is when you have more classes, Abby. On weekdays you have just one subject. On weekends, a day like a Sunday, do you have more than one paper? As in more than one class, rather. Do you have more than one class on Sundays?
Yes, 3 classes.
So you've had a class before this one.
Yes, 2 classes before this one.
Wow. All right, we'll find a way around it because I'm trying to see if I can.
They have class in the afternoon. Because the class can be earlier.
What time?
But I think they have class like from morning down to evening.
I thought you said the class can be earlier. The class before this one, when does it usually end?
Yes, but I think the way they said.
I didn't get that. The class before my battery. The class before this one, when does it normally end?
12:31-ish. That's when it ends.
Wow. Wow. Okay. I'll just have to leave church early. I want to believe I'll communicate on the group so that people are aware. Maybe we can do 4 p.m. next week. If I knew your class was ending that early, maybe we'll not be doing this, although I've been very much occupied with some other activities, but we can do 4 p.m. I'll cascade to the general group. All right, thank you very much, guys. Like I always say, if you have any issues whatsoever, you can always go back to the recorded class. If that's not working, you can always reach out to me. I'll always give you my attention. Just drop a message and then I'll respond. Thank you very much. See you next week.